Hello, welcome to our classes. I am Dr. K.K. Misra. This is Companies Act 2013. This video tutorial is on meetings. This is part 7 of this series of the key highlights of Companies Act 2013. Now, Companies Act 2013 meetings of the board and its powers. Meetings of the board and its powers. There have been significant inroads made by the MCA in the recent past with respect to giving cognizance to use of electronic media in day-to-day operations of corporates. Because of the technological advancements in information and communication technology, these changes became pertinent to be brought into the system. The Act 2013 of Companies Act 2013 takes this further by allowing use of electronic mode for sending notice of meetings, which earlier did not used to happen in Companies Act 1956. The detail of it is given in section 173, subclause 3 of Companies Act 2013. Passing of resolution by circulation, that is section 175 of Companies Act 2013, and other areas. Some of the other significant changes in relation to the board and its functioning include: first, audit committee. The requirements relating to audit committees was first introduced by the Companies Amendment Act 2000. The audit committees are a measure of ensuring self-discipline constituted with the object to strengthen and oversee management in public companies and to ensure that the board of directors discharge their functions effectively. The 2013 Act acknowledges the importance of an audit committee and entrusts it with additional roles and responsibilities. Section 177 of 2013 Act. This clearly defines it. However, the fact that the 2013 Act is not entirely in harmony with the requirements of Clause 49 of the Equity Listing Agreement cannot be ignored. While most of the requirements, including establishment of a vigil mechanism for directors and employees to report genuine concerns that are similar to requirements of Clause 49 of the Equity Listing Agreement, have been incorporated in Companies Act 2013. The differences are as follows. These are important to be clear to all. As per the Companies Act 2013, the audit committee should have majority of independent directors. Chairman of the audit committee need not be an independent director. A majority of the members of the audit committee should be finally literate, that is, should have the ability to read and understand the financial statements. Every listed company and the following class or classes of companies as prescribed in the draft rules should establish a vigil mechanism for directors and employees to report genuine concerns, such as companies which accept deposits from the public, companies which have borrowed money from the banks and public financial institutions in excess of 50 crores of rupees. Now, nomination and remuneration committee and stakeholders relationship committee. The Companies Act 2013 also includes this new section requiring constituting the nomination and remuneration committee by every listed company and the following clauses of companies as prescribed in the draft rules. A. Every listed company. B. Every other public company that has a paid-up capital of 100 crore of rupees or more, or which has in aggregate outstanding loans or borrowings or debentures or deposits exceeding 200 crores of rupees. The Nomination and Remuneration Committee is required to formulate and recommend to the Board of Directors the company's policies relating to the remuneration for the directors, key managerial personnel, and other employees. Criteria for determining qualifications, positive attributes, and independence of a director. The detail of it is given in section 178 clause 1st of Companies Act 2013. Further, A board of a company that has more than 1,000 shareholders, debenture holders, deposit holders, and any other security holders at any time during a financial year is required to constitute a stakeholders relationship committee. The detail of it is given in section 178, clause 5 of Companies Act 2030. Now we will talk about disclosure of interest by director. The 2013 Act prescribes similar requirements with respect to the disclosure of interest by the director as contained in the existing section 299 of the Companies Act 1956. The only change that could be identified is where a contract or arrangement entered into by the company without disclosure of interest by director or with participation by a director who is concerned or interested in any way, directly or indirectly, in the contract or arrangement shall be voidable at the option of the company. The detail of it is given in section 184 of Companies Act 2013. Now, contributions to charitable funds and political parties. As per the Companies Act 2013, the power of making contribution to bona fide charitable and other funds is proposed to be available to the board subject to certain limits. The detail of it is given in section 181 of Companies Act 2013. As per the existing requirement of section 293 of the Companies Act 1956, such power could only be exercised in the general meeting in case of public companies and subsidiaries of public companies as per the Companies Act 1956. Further, the limits of contribution to political parties is proposed to be increased to 7.5% of the average net profits during the 3 immediately preceding financial years. Section 182 of Companies Act 2013 from the existing limit of 5% under the Companies Act 1956. Now, loans and investment by a company. The Companies Act 2013 also states that companies can make investments only through 2 layers of investment companies subject to exceptions which includes company incorporated outside India. The detail of it is given in section 186 of Companies Act 2030. There are no such restrictions which are currently imposed under the Companies Act 1956. Further, the exemption available from the provisions of section 372A of the Companies Act 1956 to private companies as well as loans or investment given or made by a holding company to its subsidiary company are no longer available under the Companies Act 2030. Related party transactions. Most of the provisions under section 188 of Companies Act 2013 are quite similar to the requirements under sections 297 and 314 of the Companies Act 1956. Some of key changes and wishes in the Companies Act 2013 include the following. Need for central government approval has done away with. Next, the 2013 Act has widened the ambit of transactions such as leasing of property of any kind, appointment of any agent for purchase and sale of goods, material, services or property. Cash at prevailing market price has now been substituted with arm's length transaction, which has been defined in this section. Transactions entered into with related parties now to be included in the board's report along with justification for entering into such contracts and arrangements. Penalty for contravention of the provisions of section 297 was covered in general provisions in Companies Act 1956. However, this is now covered especially in the section itself, which now extends to imprisonment. Central government may also prescribe additional conditions as and when required. So this was all about this video tutorial. I hope that you have liked it. And if you have liked it, please do not forget to subscribe my YouTube channel or classes and press the bell button and pass it on to others, those who are needy now and in the future. Thank you. Please like, share and subscribe. Thank you very much. Have a nice time. Best of luck.